Hello guys, welcome to the Frequency Unit FX Trading channel, and in today's video we're going to be doing a video on the topic called the Ultimate Price Action Trading Masterclass. And as you can see on the screen, I have everything we're going to be learning written for us to learn from, so that we are not confused as to where we're going to be learning them and how we're going to be directing our motives and attentions to. So this class is targeting traders, the beginners, the very beginner traders, to the intermediate traders that are already in this market, so that they understand better what this concept would be for them in their trading journey. So from the beginners to the intermediate traders, you can learn from this video. So the format for the video script and teaching guide, the section 1 is the introduction to the price action trading. Okay, so let us read and then we're going to be learning along. Welcome to this masterclass on price action trading. In this guide, we are going to strip away the noise of the laggy indicators, complex mathematical overlays, and cluttered chart setups. You will learn how to read raw market price movements, interpret market sentiment, and make objective trading decisions based on institutional footprints left, right on the chart. So what I just read out right now is to let you know that we're going to be learning how we can leave out indicators and all of those complex mathematical overlay, including the Elliott wave strategy that we've been teaching, and just break all this into a simple overlay, a simple format, and that is the price action. Price action trading is the discipline of analyzing raw price movement over time without relying on secondary technical indicators like RSI, MACD, or moving averages. When you look at an indicator, you are looking at a formula derived from past price action. By analyzing the raw price directly, you eliminate the delay and see supply and demand dynamics as they unfold in real time. So this is saying when you let go of all of the indicators you used to use, all of the Fibonacci, all of the very, very, very complicated technical analysis and tools you used to have on your screen, it's going to be very easy when we apply this price action trading to the topic. So we read on. Every tick up or down on your screen represents a transaction between a buyer and a seller. When buyers are more aggressive than sellers, price rises. When sellers are more aggressive than buyers, price falls. Price action analysis helps you identify who is in control, where institutional orders are setting, and where the market is most likely heading next. So let me take you to the chart so you understand what I just spoke here. So you see, As I zoom into this chart, like you can see, like all of you can see on the screen right now. Let me clean all this chart so you see. So as you can see on the screen right now, all these movements made by the chart is a pure indication of price action movement. Okay, you see all of this red candle, all of this green candle, this big one and this small one you see right now on the screen are all the eliminations of price action, the raw execution of what the market is doing with what people are underlyingly trading it as to say. So price action is the raw price movement for reading your understanding in this price. So let's say price action tells you that when this green candle went up and this smaller one went up, this, let me use this so you see properly, this green candle went up, this one went up smaller. It means when people bought here in this 1 hour time frame, they buy and they were buying up, and when it got here, this was where the market stopped at, and price action simply tells us that because it stopped here when it started here and then it started going up, the price action behind this is there was no much momentum buying power. Price action has just given you an insight on what the market is doing. So price action is this anatomy that helps you predict or talks this market without the use of complexity like we read. We're going to go back and read more of what we are talking about so you understand. This movement is price action. Let me take out all of this indicator so or let me just hide it instead of, because we used to use this indicator for analysis. Instead of just taking it out, let me just hide it. So there is no indicator telling us. Usually when the indicator was there, the indicator was telling us it was up, but now there's no indicator, so the indicator is not there, and the raw price movement is what we see on the screen. This shooting star candle is price action. This green candle is price action. You can tell from price action analysis that this market started here, came down a bit, got here, up, went all the way up here, and then stopped here. And price action told you that after it stopped here, the market started a movement with this. The market started this movement with this red candle, and that the red candle started pushing lower. So that is the price action we are talking about here. The price action is what has just read itself without the use of any so-called indicator whatsoever. Let us go back to what we were reading for better understanding. So, section 2, core foundations, anatomy of a candlestick. To read price action, you must first master your fundamental tool, the Japanese candlestick. Every single candlestick tells a story of a battle between bulls and bears over a chosen time frame, 1 minute, 1 hour, or 1 day. Every candlestick consists of 4 core price data points. The open, which is the O. Of course, I'll show you this on the chart when I go over there. The price where the season started, the I. that is the H. The symbol H is what represents the I, and that is the highest price level reached during the season. Then the low, and that you see the symbol L, that is the lowest price level reached during the season. And then the symbol C, which represents or means close, and that is the final price level where the season ended. Let me go back to the MT5 chart so you see all this in display up here. So let me use this so you see what I'm talking about. So when I use this arrow line, you can see, of course, there's usually an high, low, and all this, but I think it's usually in the settings. So let me just go ahead and put it so that you see it right now. Where is we call this the OHLC, the open, the high, the low, and the close. This is what we just read right now. So now I've already toggled it on. You can see the open of any price that is moving, the high, the low, and then the close. So if I make use of this cross here, if I make use of this cross share and pointing it on this red candle, when I pointed it, what displays here is the open is the first you see here. The I, that is where the market got to in the highest form as it was moving. It reached that area. That's the I. And then the low is where the market reached in the deep of its movement. And then the C, the last, is the close. And that is where the market closed at. So let's go back to what we're reading now. The rectangular center of the candle is called the real body. If the close is higher than the open, it creates a bullish candle, typically colored green or white. If the close is lower than the open, it forms a bearish candle, red or black. The thin line extending from the top and bottom of the body are called wicks or shadows. The upper wick represents price rejections at higher level. Sellers stepped in and pushed the price back down before the season closed. The lower wick represents the price rejection at lower level. Buyers stepped in and pushed price up before the season closed. Section 3. Market structure and trend identification. Before entering any trade, you must, of course, what we just read here, I already showed you in the MetaTrader 5 chart. So anytime you need to look at it for yourself, all you need to do is go over to the chart and use the example I showed you right now on the screen as a reference to seeing what we are teaching you here. So now we are going to read further to understanding more of what we're teaching. So before entering any trade, you must first identify market structure. Price does not move in a straight line. It moves in waves of expansion and contraction, called impulse legs and corrective pullbacks. Market structure falls into three distinctive phases: uptrend, bullish phase, characterized by a sequence of higher highs and higher lows, and that is the HL. So when we talk about uptrend, a market that is moving upward, we characterize that with the symbol HH that tells us it is a higher high. And then if we talk about the higher lows, we characterize it with the HL symbol that tells us the market it's pushing forward and then retracing back. Let me go to the chart and show you what I'm talking about. So this is okay, I can just show you here right now. Okay, let's say this is a chart. Okay, this is a chart. So what is higher high in this chart right now? This is a higher high, this area is a higher high, and this area is a higher high. Now, buyers continuously push price to new heights and pullbacks are caught higher than previous low. So where is my pushback? This is my pushbacks, and we call this a higher low. Why? Because anytime there is a high low here, there is going to be another high low here. So when the market pushes up and it pushes back down and it goes back up again and it comes back down, the retracements are called the higher highs. Okay, the higher lows. Okay, so these are the lows underneath, and this is a very, very indicative example of what we are teaching. So then for the downtrend, this is where we are currently reading at. This is where we're currently reading at. And it says downtrend bearish phase characterized by a sequence of higher lows, and that is the LH and the lower lows. Sellers continuously push prices down and attempt to rally fail below previous swing highs. Let me draw that so you see it. Just like we have it in the higher high, we have it in the higher low too. So this is the lower low. So this is LL. This is LL. This is LH, lower high, lower low. This is another lower high, and this is another lower low. So all these are then called the market structure, and this is the downtrend. So from the reading, you should be able to understand. After these illustrative examples on the screen, we are going to go to the chart and expand it in a very, very explainable format. So you see it real in the chart doing its thing. So number 3 is consolidation, range sideways phase. But before we show you the sideways, let me just take you to the chart and show you this in real time. This is the chart, and this is how we identify higher highs and higher lows. This played very well in the step 400 index. This is the higher high of this asset, and this is the higher low of this asset. This is another higher high of this asset. This is another higher low of this. For the downtrend that we just read off, this is the lower low. This is the lower high, sorry, and this is the lower. Let me clean this up so you see properly. This is the lower low, lower high, lower low, lower high. Guys, I hope you're learning something here, because this is the premium. This is something we teach in the premium course. Premium subscribers. So if you're learning this here right now, it's because you're actually seeing it working live. So it's a live video. Okay, so you can send your comments. I opened the comment section for you to comment whatsoever you think about what we're learning, and share your thoughts, and then if I have to, I might reply you. I see 700 people currently tuned into this, and it is not a problem for me. So you should be understanding this, because it can help you win. If you're winning, you should be happy, because the courses that makes you win makes you a stronger person. So, of course, I'm in a very public market, and you can hear all the noises all around. It's the big market Yaba, and all this happens occasionally or the sound. So worry less. As long as you're hearing everything I'm saying, there is no issue at all. So we are reading on. So we are in the. All right. Where were we at, guys? Okay, so we are in the number 3 of this reading, which is the consolidation, the range sideways phase. Price moves horizontally between defined supports, floor and resistance selling levels without making net progress up or down. This is what a ranging market simply means. It is not going up and it is not going down. The market is just going sideways over and over again. It is refusing to go upward or going side or downward, and that's just the sideways movement of this chart. So I'll show you that as well in the market. And then we are reading the consolidation sideways phase. Price moves horizontally between defend support, floor and resistance selling levels without making net progress up or down. Market structure shift break of structure. An uptrend remains valid until price fails to make a higher high and breaks below the previous higher low. Conversely, a downtrend ends when price breaks above the previous lower high. This structural break signals a potential overall trend reversals. So let me show you this in the market right now. Let me show you a ranging market in the market right now. So this is a ranging market. This is a perfect example of a ranging market where a market is refusing to go either up or down. Where the market is refusing to go in either up or down, it just keeps going up, it comes down, it goes up again, it comes down, it goes up again, it comes down, and then it comes down, and then instead of going up, it doesn't go up, it just moves sideways. And this is a sideways market, and that's what we're reading right now. So we just keep on this lesson. I just need to show you this on the chart. So that you see it and you can understand how you can work with it by yourself without the aid and support of anybody. So the section for key level, support, resistance, and supply / the demand zone. Price action setups require horizontal context. You do not buy or sell in the middle of a range. You look for signals at key structural levels. So now we are telling you where to buy at or where to sell at. So you are not just going to buy when you see the market ranging. That is not the proper way to buy. When you see the market ranging, that is the best time to wait. And when the market breaks, you're going to draw a resistance line inside of the middle of the moving market, so that when it breaks down like this, you are ready to sell. So that is what we're talking now. So support a price. I'll show you in the chart what this means. Okay, a price level or zone where buying interest is strong enough to overcome selling pressure, preventing price from failing further. Resistance, a price level or zone where interest is strong enough to overcome buying pressure, to overcome buying pressure, preventing price from rising higher and higher. So Let me read that again for a better understanding. What a support is. A price level or zone where buying interest is strong enough to overcome selling pressure, preventing price from fading further. So you know what support means. So this is a support. This line is a support. So when the market hits here and goes down, it hits here, makes a lower, and it hits here again. So this line is going to serve as a support line. This line is going to act as a support line, and that support line is where people look onto before they execute a sell trade. So that's the support, okay? So that is what that thought tells us right now. And then so a resistance is this. Let me draw a line for a resistance. So this is a resistance. Market is hitting this level and it keeps hitting it and then resisting, and then you buy because it's here again. So let's say the market was ranging in the middle of this area. When it breaks this area, it hits a resistance, a support level, and then goes up, and then vice versa for the downward. If it goes up, it is resisting, and then it breaks, and then it resists for the last time and goes downward, and then the cycle moves. It is a very probable pattern. It's a very probable entry signal to use for accurate signal entry. Let me show you on the chart. Very simple terminology you all can use, okay? You all can use for executing trades. As you can see here, it played out very well. For this reason, I'll be using the box 2 for a better explanation. So this is the box 2, and the market was ranging, and immediately it broke, just like I showed you in the example. The market was ranging, and then the support, this was giving a support, a fake support, and a fake resistance, and immediately it broke. It gave the last resistance, the last support before it rises up. So that is what we call the resistance, the support level for a trade entry, as for the market entry we are taking. So my audience are going to be hearing. All right, so that's for the support there, and you can see it play out so well. So let me take you back to the reading so you understand us better. So role reversal, flip levels. Once a major support level is broken to the downside, it frequently flips to become future resistance. Guys, we'll be ending this video here right now, and I'll be making a part 2 of this. So people who were not able to finish this course are going to go back to are going to stream the second side of the video for the remaining course that are going to be displayed here. So guys, see you in my next video, and I'll be ending the live stream as well. Bye guys, this is Frequency in its FX Tradition.